Welcome to Thoughts Through AI, where we dive deep into the realm of futuristic ideas and cutting-edge technology. Different countries have different currency values, and it all boils down to a mix of factors that shape their economies. First off, let's talk about supply and demand. Just like any product, if a currency is in high demand, its value goes up. For example, if a lot of people want to invest in a country, they need its currency, which boosts its value. Conversely, if a country is facing economic troubles, its currency might lose value because fewer people want it. Next up, inflation plays a huge role. If a country has high inflation, the purchasing power of its currency decreases. Imagine going to the store and seeing prices skyrocket overnight. That's inflation at work. Countries with lower inflation rates tend to have stronger currencies because their purchasing power remains stable. Interest rates are another key player in currency value. When a country raises its interest rates, it often attracts foreign investors looking for better returns on their investments. This influx of money increases demand for that currency, driving its value up. On the flip side, if interest rates are low, investors might look elsewhere, causing the currency to drop. Political stability and economic performance also cannot be overlooked. Countries that are politically stable and have strong economies tend to have stronger currencies. Investors feel safer putting their money in these countries, which boosts demand for their currency. In contrast, countries with political unrest or economic instability often see their currency values plummet as investors pull out. Trade balances impact currency values too. If a country exports more than it imports, it creates a demand for its currency. For instance, if Germany is selling a lot of cars to other countries, those countries need euros to make those purchases, increasing the euro's value. On the other hand, if a country imports more than it exports, it can lead to a weaker currency because there's less demand for it. Let's not forget about government debt. Countries with high levels of debt might struggle to attract foreign investment, leading to a weaker currency. Investors worry that the country might default on its debt, which can cause the currency to lose value. Conversely, countries with manageable debt levels are often seen as safer investments, helping their currency maintain strength. Speculation also plays a role in currency values. Traders in the foreign exchange market buy and sell currencies based on their expectations of future movements. If traders believe a currency will strengthen, they'll buy it, which can drive its value up. If they think it will weaken, they'll sell, causing its value to drop. This speculative trading can lead to fluctuations in currency values that might not always reflect the underlying economic fundamentals. Cultural factors can influence currency values too. For instance, countries with strong cultural exports, like movies, music, or fashion, can see increased demand for their currency as consumers worldwide want to buy those products. This cultural influence can subtly affect currency strength over time. Global events can also shake up currency values. Natural disasters, pandemics, or geopolitical tensions can create uncertainty, leading to fluctuations in currency values. For example, during the COVID-19 pandemic, many currencies experienced volatility as economies struggled and investors sought safe havens. Lastly, central banks play a crucial role in managing currency values. They can intervene in the foreign exchange market to stabilize or influence their currency's value. For instance, if a currency is falling too quickly, a central bank might buy its own currency to prop it up. Alternatively, they might lower interest rates to stimulate the economy, which could lead to a weaker currency. In summary, the value of a country's currency is influenced by a complex interplay of factors, including supply and demand, inflation, interest rates, political stability, trade balances, government debt, speculation, cultural exports, global events, and central bank policies. Each of these elements contributes to the unique currency value of every nation, creating a dynamic and ever-changing landscape in the world of finance. Understanding these factors can help make sense of why currencies fluctuate and why they hold different values across the globe. So, the next time someone wonders why the dollar isn't worth the same as the euro or yen, it's all about the intricate dance of these economic forces at play. It's a fascinating world out there, and currency values are just one piece of the puzzle that reflects the health and stability of nations around the globe.